From the morning reading, the broad market pauses as the FOMC begins a two-day meeting. 5 of 9 sectors moved higher on Tuesday. XLI, XLB, and XLE were the strongest sectors, while XLU was the weakest sector. All futures fell 41 cents to close at 42.64. Breadth strengthened compared to the prior session as advancers led 1820 to 1146 on the New York Stock Exchange and led 1574 to 1011 on the NASDAQ. The FOMC began its two-day meeting on Tuesday, which will culminate with the Fed announcement on Wednesday at 2 p.m. Eastern Time. No change in interest rates is the expectation. On the S&P 500 snapshot, a flat finish before the Fed on Wednesday. U.S. equity indices traded in a narrow range and finished mixed ahead of the Fed Wednesday. Our benchmark S&P 500 exhibited a bit of volatility in the first 90 minutes, hitting its intraday high and low about an hour apart. The index then struggled with yesterday's closing price, the prior session, during the lunch hour and again at the close. It managed to eke out a 0.03% gain as we move toward tomorrow's, read today, FOMC minutes and rate decision. Expect by most analysts to remain unchanged. The yield on the 10-year closed at 1.57%, down 1 basis point from the previous session. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:40 a.m. Mountain Time, and I am recording this in preparation for the market day of July the 27th, 2016. Remember that on YouTube you have a free subscription to the channel and be alerted to new content as it's being published. Give the video a few minutes after being published for the video to be available in high definition. Click on the setting button to choose the high definition playback level. In this same area, you can also control the speed of the playback. I routinely find that I can fully understand videos at about 1.5x the recorded speed. Also note the full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the broad market U.S. indices were up. The S&P and the Russell were up just above scratch. NASDAQ up about 0.75%. Dow up about 0.25%. Crude oil down about 0.25%. Euro up just above scratch, as is long bonds. And then gold is up about 0.2%. China is up about 0.33%, as is Hong Kong. Japan's up about 1.7%. Germany's up almost 1%. United Kingdom's up about 0.2%. And macroeconomic reports for today. Of course, the big one is the FOMC statement with its associated federal funds rate announcement. You also do have the weekly crude oil inventories, core durable goods being reported today. So a pretty big schedule on the macroeconomic report that will definitely change the market direction, have an impact on price as we go back and forth. In terms of looking forward to tomorrow, we have the weekly unemployment claims, natural gas storage, and that looks to be about it. In terms of current volatility conditions, let's see here. Well, short-term VIX almost to a 12, so it's been coming up. SKU also has now gone up over 130, so that continues to tick ever so slowly up. IV percentiles are all still single digits, but not as low as they were. On the S&P, the IV percentile is a 9, the Russell an 8, the NASDAQ a 5, and the Dow a 6. No standard deviation moves were put in yesterday on any of the indices, and indeed, you potentially might get some market action in the first hour after the cash open today, but usually what happens on an FOMC day is that it goes sideways and just gets real quiet, low volume, really poor follow through on any intraday signals, and just kind of waits until the FOMC announcement, and then you get the fireworks and the real price movement for the day. So just kind of keep that in mind if you're trying to put on or take off positions today ahead of the FOMC announcement. The price action's likely to be very much altered by this type of day. In terms of our current charts, let's go ahead and go to the S&P, and we see just again another day where we have this sideways action. We kind of tickled the low area of recent action, but when it was all said and done, we closed, we were back up near the high of the action of recent days. So far today, we're tickling that high area once again, but nothing of any significance. We're still all within the price action of this last week plus, and have really achieved nothing of note. In terms of the recent action, it has been oscillating up day, down day, up, down, up, down, up, down, and then yesterday did manage to squeak out another up. So that pattern has continued as the short-term traders would seem to be just kind of playing back and forth like ping pong. In fact, there's even a strategy called ping pong, and that may very well be what's going on with some of the short-term traders as it is right now as we head into the FOMC. Now, obviously, with the FOMC announcement today, all expectations are that there'll be no change in interest rates. If there were to be a change, that would cause a huge reaction in the market because it'd be such a surprise. That's not expected. That's a very low probability. And if you look at Fed fund rate expectations as priced into the bond market, there really isn't any expectation from a probability standpoint in the rest of 2016. But the language of what's released will also be very carefully parsed, looking for nuances as to changes coming forward, as well as insights into what the Fed thinks is the health of the economy. And that likely could cause some volatility as people take the headline and then actually read the material and digest that, and then you'll start to see the market actually respond in a more cohesive way. So just expect that things could be really rocky there for a while. On the Dow, while we did break yesterday's low of the range, a little bit of a departure for the pattern on the S&P, it still is trading inside the range of the consolidation pattern. This one looks more like a bull flag at this pattern than the S&P does. And, again, don't expect it to mean anything until we get past the FOMC announcement and break perhaps to one side or the other. NASDAQ's been setting new highs. Apple came out with some strong expectations going forward. Did beat on the expectations, but not by much. Mostly this seems to be driven by the language that was associated with the forward expectations, and so Apple will be pushing the market, especially the NASDAQ, higher this morning. Also, you have the Russell. The Russell has been toying with the top of its own sideways consolidation, and you could say that it did have a breakout, as it were, yesterday, pretty subtle. So far, it's holding on to that, but not adding to that. So this is a pretty quiet pattern, but it nevertheless has started to tickle out of the upper side in anticipation of perhaps a potential breakout to the upside. So kind of keep that in mind. In terms of where are the risk on, risk off kind of markets, bonds also have gone sideways going into the FOMC announcement. Gold, which, by the way, if you're a gold trader, your contracts have probably rolled over to the December contract, though actual volume still seems to be a little higher on the old contract, at least for today, but that'll likely equalize, and most traders will be on the new contract today. That always makes trading the gold market tricky on rollover day, so just be aware of what's going on with that. But gold seems to be, but you know what, I'm not going to make too much of this chart because of rollover. It's just too messy. We'll give this a couple days to kind of settle out. Okay, let's take a look at crude. Crude, of course, has broken down through that diagonal support structure that I had drawn, and also broken down below the cloud. So this is not good for the crude bulls by any measure, and also not good for many players in the energy sector. So we'll have to see where this goes, but this has the potential in terms of support and resistance of breaking down, you know, a couple, $3 more before significant support might be held. So we'll have to watch, see how the dollar plays with that. And you see the dollar has been rising, and that, of course, has an impact on many of these other markets, but especially on crude. And then let's take a look at the volatility. Volatility, of course, has been relatively sideways after the post-Brexit volatility crush. While it has, in quotes, signaled a bullish move with yesterday, it's still, you know, not really broken out. We could draw a box around this recent activity and really is in a sideways consolidation pattern and really hasn't done anything as of yet. Not likely to until the FOMC announcement today. Then we'll probably see resolution on a number of these markets. That's probably enough on the charts. Let's go ahead and go to the daily report. So on our daily report, pretty much status quo from yesterday. Our intermediate term phase opinion is still market phase 2, trend reversal, the break of diagonal and horizontal resistance. And our 3 market timing signals, no changes. Confirmed uptrend in the first one. Mechanical signal that comes to us from IBD. GMI index still a perfect 6 out of 6 with its buy signal in place since July 1st. And on the third one, the stock charts decision point scoreboard status still short-term and intermediate term universally green. We've had some flirting with neutral signals on the short term, but nothing has converted. We are still up against this long-term mixed signals. That is the lone fly in the ointment in terms of these primary mechanical signals that we use on the market timing. Position sizing opinions are 100% on both. Intermediate term phase, intermediate term market posture is on all 4 indices still very, very, very strong. In fact, essentially up over 95 on 3 of the 4, and the Dow just barely below that. This is also supported by a bullish sentiment line. So probabilities are that this will continue to be very strongly bullish going forward until proven otherwise. Strength of the trend also strong. Hedge warning status remains 0+ normal with some cautionary aspects. Strategy opinions, no change from yesterday. I would continue to guard against initiation of a lot of new positions ahead of the FOMC announcement. Get that information out, let it digest for at least half an hour, if not an hour. Get some understanding as to what the implications are to the market, and then potentially then start setting up. If you get a big down move post-Fed announcement, then that's when you pull out your watch list on put selling and start considering in the next day or so an opportunity that might present itself in a retracement to be able to put on some of your put selling positions. In terms of the specific warning areas, the same 2 kind of low grade, albeit the skew has now gone up over 130, so it's starting to increase in its interest to us in terms of being a warning. But still, both of these are the only things that are really as you see in red as a warning status at this time. There are no warnings coming from the trend-based group, and indeed the bulls are putting in strong signals to the positive side. On the key intermarket risk aversion indicators, they're all still risk on. But I will say that these lower three are starting to show some signs of potentially rolling over. It's early, the curves are just starting to move, so we don't want to make too much of that yet, but it's the first evidence that we've seen in what I've come to believe is a pretty good set of indicators to show us swings in the market in terms of our intermediate term market postures and warnings and so forth, the first sign of some warning that this may be starting to change its condition. So just kind of continue to watch that and see how this develops. Remember, these are intermediate term signals. These are not meant to be, traded off on an intraday basis. Sentiment indicators somewhat elevated for stocks, both short and medium term. And then also the fear and greed index also elevated, though the score did not change at all from the prior day. In terms of sector percent change in market postures, you see consumer staples on the short to intermediate terms in a neutral status, and energy, of course, has been struggling in recent days with a intermediate to short down market posture and a long at neutral. So definitely two sectors that are showing the most weakness. All the others are pretty much a sea of green, albeit some of them more strongly than others if you were to actually dig into the particulars. In terms of percent change, you see industrials, materials, information technology were up yesterday. Let me just take a look at that. I'm starting to wonder if maybe that one didn't get rolled over and updated. Let's take a look at this. Well, XLE was up yesterday, so there were certainly some components of the energy sector that were down yesterday, but energy as a sector, as defined by the spider sectors, was up. So anyhow, most of these look to be the higher beta risk on kind of areas, whereas look down here at the bottom, telecom, utilities, consumer staples, bonds aren't on here, but this is basically our stubs. They're the ones that gave it off yesterday. So coming into the FOMC, it would seem that some traders were taking a risk-on approach and rotating out of the stubs and rotating out of some of those that were the most interest rate sensitive and going into risk-on assets. So that's kind of interesting. We'll see if that's the right call after the FOMC announcement comes out today, and if indeed that gets followed through, or if that's just kind of short-term trading in front of a Fed announcement by people trying to get out of and perhaps even take profits in some of these interest rate sensitive areas, and then and then maybe even re-enter those positions after the announcement. So let's not make too much of this yet, but that is kind of interesting. We'll see where it goes. Okay, I think that's probably enough for today. Let's go ahead and hit our disclaimers. Disclaimers, as always, hit the pause button if you need to have some more time to review this. Also note down here the full hyperlink if you need to go to that to find the full set of disclosures. We'll be back for our next market preview from Falcon Global for tomorrow's session. In the meantime, be sure to manage that risk. You do that, everything else should fall into place. And then, of course, go learn things every day. Good trading.